If I told you the next major credit crisis is already modeled, already quantified, and potentially worth $41 trillion, would you believe me? Because this one isn't about subprime mortgages, it isn't about dot-com stocks, and it isn't about crypto speculation. It's about physical reality and leverage. By 2050, Moody's estimates physical climate risk alone could reduce global GDP by 14.5%. That's $41.4 trillion. In lost economic output, not transition costs, not carbon policy, physical damage, floods, heat waves, wildfires, sea level rise, agricultural disruption. 2/3 of that loss comes from chronic deterioration, not dramatic disasters. Slow productivity decay, permanent coastal exposure, heat, silently reducing labor output. This is not volatility, it is structural erosion. Now zoom into the United States. Projected GDP loss, 9.5%, $6 trillion. Annual disaster damages, expected to be 26% higher than 2020 levels. Corporate operating margins, projected to fall by 2 full percentage points. That equals roughly $1.5 trillion in corporate damage. And this is where private credit enters the picture. Private credit was built on stability, smooth returns, no daily price swings. But removing daily marks does not remove risk. It postpones recognition. Many private credit deals were structured at 7.5 to 8 times debt to EBITDA. Translation: a company generating 100 in operating earnings may carry 800 in debt. Interest coverage in many middle market transactions sits around 1.7 to 1.8 times. Thin. Now apply structural margin compression, 2 percentage points from physical disruption, 10 to 15%. Earnings declines from rising insurance, labor stress, supply chain shocks. That 8 times leverage becomes 9 times, then 10 times. Interest does not fall automatically. Debt does not shrink automatically. Refinancing windows do not stay open forever. Leverage is gravity, and gravity does not negotiate. Now consider commercial real estate. Moody's modeling suggests a representative CRE loan portfolio could see a near 18% increase in default probability, a 22% increase in expected losses in certain metropolitan areas, like New Orleans. Default probability could rise more than 40%. Expected loss, nearly 62% higher. Risk does not distribute evenly. It clusters, and clustering is how credit cycles go nonlinear. Private credit portfolios are heavily concentrated in services, technology, healthcare, and asset-intensive businesses. These rely on facilities, on labor productivity, on regional economic stability. If heat stress reduces output, if migration shifts tax bases, if insurance premiums permanently reprice coastal assets, the macro flows directly into micro balance sheets. Moody's estimates average probability of default increases of 74% when physical risk is integrated into 2050 credit models. 74%. Not catastrophic today, but mathematically unstable. If leverage is high, opacity multiplies the effect. Public bonds trade daily. Stress is visible. Private loans are marked periodically. Deterioration builds quietly. And when marks adjust, They rarely adjust gently. They adjust when refinancing fails, when earnings miss, when liquidity tightens. Now add interconnection. Private credit borrowers often overlap with syndicated loans and high-yield markets. The same sponsors, the same capital structures. Banks and insurers lend to private credit vehicles, provide lines, structure products around them in expansion. That is diversification. In stress, it becomes correlation. Now step back to 2024 global catastrophe losses, $320 billion. Insured losses, $140 billion. Fifth consecutive year, above $100 billion. In insured catastrophe losses, these are not theoretical projections. They are realized losses. The 2050 projection is not speculation. Detached from reality, it is an extrapolation of frequency and severity already visible. This is not a traditional recession model. Recessions are cyclical. Physical risk is cumulative. Heat compounds. Sea levels compound. Insurance reprices permanently. Chronic risk does not reset. After a quarter, it embeds. Private credit was engineered in a world of zero rates and abundant liquidity. It is now operating in a world of higher rates, tighter liquidity, and structural physical disruption. Same leverage, different environment. Defaults today sit in the mid-single digits, 3 to 5%. Digestible. The concern is what happens if defaults move into the mid-teens. At that level, losses stop being portfolio noise. They become capital events. And capital events trigger repricing. This is not about apocalypse. It is about arithmetic. If global GDP structurally compresses by 14%, asset valuations must adjust. Regional growth assumptions must adjust. Credit spreads must adjust. Private credit is not insulated from physics. It is simply slower to reflect it. The surface remains calm. Coupons are paid. NAVs look steady. But beneath that surface, chronic stress accumulates. When high leverage meets structural earnings, compression, markets do not argue. They reprice. The only unknown is speed.